I have to apologize for that. My Wi-Fi just tripped off for reasons which I really cannot be able to detect for now, but I think we are good. So I was explaining that this is a bearish order flow because of it's going down. The market makers are pushing price down, and when they are in this model, the market makes lower lows. So this is a low. Oh, sorry about that. Okay, so this is a low. So this is a lower low to this low. You see that the market made a lower low. You can see there. So look at it. This low took out this previous low, lower low. This is another low, took out this one, lower low. So when it is coming down, it makes lower lows and lower highs. We see that play out everywhere we go. So this is or let me call this a high. So this is a low, then this is a high. As it trade up, it did not trade higher than this high. It traded lower than this high, so it's a lower high. So this is a lower low, but a lower high to this previous high. So it's a lower high. So we have lower lows and lower highs and what have you. So now this was in a bearish institutional order flow. So when the market makers are pushing price, we have sell side imbalance, but a buy side inefficiency. Another sell side imbalance, the buy side inefficiency. They do the buy side inefficiency to cover up the large void that have been created in price. So when the market is selling, when they are pushing price downward, we say that institutional order flow at that point is bearish. So we have bearish institutional order flow and we have bullish institutional order flow. But now we are seeing in the marketplace that we are observing a bearish institutional order flow. We are observing a bearish institutional order flow. So in the previous slide, don't forget I said that price moves to take out liquidity and to fill up an imbalance. Observe when they took out this high. Look at this high. It looks very tiny, but they took it out. Look at. They took out this high. This is where retail traders we think that it's a resistance and they will play their stop loss here. But look at, they took it out and they went down with what? With speed. They went down with speed. So price, at this point, it came to take out liquidity. It came to take out liquidity. Liquidity is also seen here in these old lows. Look at how they took out the lows. Look at how they retraced up. They came up down again to hot what? More liquidity. These are more liquidity. They came to hunt more liquidity, as in form of old lows. The next low they will look at to take out will be this low. That will be the next liquidity. They took it out. They took it out. Then the next low will be this low. This one here. So you see that this thing plays out every time. They take out liquidity. Look at how they took out liquidity. They retrace or fill an imbalance. They filled up the void, came again, they hunt for further more liquidity, went up again, filled an imbalance, came again, took out a new liquidity like we see in this old low. So before they make their movement, here they're taking out liquidity, took out liquidity, they fill an imbalance, took out another form of liquidity again. Look at it here. They took it out, they just poked it here. Then they went out. Then you have it wherever you can find it, wherever. See, it's everywhere you go. So they took out liquidity here. This was a lower low. They took out liquidity here. Now they changed their movement from selling to buying. So now this is no longer a bearish institutional order flow, but now we have a bullish institutional order flow. So a bullish institutional order flow, we have higher highs and higher lows, no more lower lows and lower highs. So this now we'll call it a bullish institutional order flow. So this will be having the opposite of that. I know that at this point it might be confusing. That's because of I really did not, I'm trying to rush everything in just this Forex manual. So the bullish institutional order flow, it has something like this. So it's going up, the market is going up. When you see green bars, mean that it's going up. When you see red bars, mean that it's coming down for the bearish institutional order flow. So let me just duplicate that. Let me not move it. This is bearish and that's bullish. Bearish IOF. So the quote for liquidity and the fill and imbalance is done with respect to the current institutional order flow. Like you see now, we are in a bullish institutional order flow, and all their movement, it will go and take out liquidity. Price moves up and down to seek yield. Price moves to seek yield. Look at how when now they came to fill an imbalance, they expanded up, came again, filled an imbalance of this buy leg that was here. They went up to take out what? Liquidity, because they know that retail traders will put their stop loss above this high, thinking that it's a resistance. But look at how they took it out and they reversed the marketplace immediately. But as they reversed it, they did two operations here. They took out liquidity, one, they came out to fill an imbalance. So this is buy side imbalance, sell side inefficiency. Understand? Buy side imbalance, sell side inefficiency. The buy side was much, but was imbalanced because the sell side was inefficient to deliver the whole buy side leg at once. So it was not delivered fully. This is the buy leg. I mean, from here to this upside was the buy leg. But look at the sell leg. The sell leg was from here to here. So it was not inefficient to cover up the whole buy leg. So that's why we say that it is inefficient. So the buy side is imbalanced, but the sell side is inefficient to cover up the buy leg. Thus, you have it here. Buy side imbalance, sell side inefficiency, buy side imbalance, sell side inefficiency, buy side imbalance, sell side inefficiency. As they are going up and down, they are going off a buy side imbalance, sell side inefficiency, or sell side imbalance, buy side inefficiency with respect to the current institutional order flow. Now you have a bullish institutional order flow, so you will see only buy side imbalance, sell side inefficiency. And they also go to target out liquidity and to fill an imbalance. So quest for liquidity, old highs and old lows. So you see something like here now. Look at here now. Look at how lovely this is. They came down. They were taking, let me start from here. It's everywhere. They took out the old highs here. Look at them. They took out the old highs here. Let me put a marker so that you see where I am eyeballing for the old highs. Okay. I'm looking for a particular. Okay. So let me put this smiling face here for the liquidity. This is where we term as liquidity. So liquidity is seen here. They took this price up, they took out liquidity. Where is the next form of liquidity if they are going down? The next form of liquidity, if they are going down, is below this low. Look at this low. This where retail traders using indicator, they will think that it's a support, but it's not a support. It's a place for liquidity. They came and took it out. Look at how they took it out. As they took them out, look at what they did. They reverse price the other way to what? Fill an imbalance. So sell side imbalance, buy side inefficiency. they went to a resistance. All these ones will teach you mostly in your intermediate class in IOC Forex Academy. I'm trying to rush everything here in one. So they took out liquidity, they retraced to fill an imbalance in price. If you also check here, they also took out liquidity here by taking out all this high, then they reversed their price because of their movement now is selling. So we'll be seeing what? We'll be seeing this is a lower high. First of all, this is a high. This is a high in the marketplace. Let me make that bolder. But we'll now see what? Here is a lower high because we are in a bearish institutional order flow. So a lower high, and we'll be seeing what? Lower lows. Lower lows. This is a lower low also. This is also a what? A lower high. We have lower lows, lower lows, lower high. Then the final one before the tide of the market change from bearish to bullish. How will I know if it want to start the bullish and bearish? That I cannot teach here for now because of time. I don't want to make the videos too long. So they go for liquidity in the form of old lows. Now that they are selling, they take out the uninformed money, the one that they think that they know what they are doing, but actually they are not. So they take out all those points. Now they change tight again back to what? Higher highs and higher lows. They call for liquidity. You can see liquidity now. Before they reversed, they took out what? A low. Look at a low there. All their aim to deliver this thing down was to take out liquidity in the form of this old low here. Look at how beautiful this thing is. Look at how it is so consistent. It is not random. Price is not random. And I can tell you for a fact why all these things went the way they did like this. All these things went the way they did like this. Understand? So the next place for liquidity, look at how when they took out this place, look at how the market reacted. Even if it was in a bullish order flow, I took out this high. Look at how it reacted down to feed what? An imbalance. By that imbalance sells an inefficiency. The market goes up like that. By that imbalance sells an inefficiency to a support. Imbalance, just like that. Just like that. It never stops. It never stops. It never stops. It never stops. That's how the market works. So this is just the basics of the market makers concept and how you look at it and how you should also trade it. It works on every pair, every pair. It works everywhere. So you can see this now. Watch at this. You think it's random. It's not random. So what did they do? They had to take out liquidity first of all. Look at the liquidity there below this old low. Look at it. As soon as they took out this old low, this one, the place of liquidity, look at how the market reversed to go and take out what again? Liquidity. Above this old high, they took out liquidity. And if I compress this, I will see on that thing here that will tell me what they really took out. Now, watch out. Look at this old high. Are you seeing how precise this thing is? Very precise. They took out that old high. Then they reversed the market because of now they want to enter into a bearish institutional order flow. So they reverse the market, feel an imbalance, expand, but it could not make on that higher high again. Observe, it could not make on that higher high again because of the tides of the market. It has changed. So they tried to make what? A lower high. We see lower highs. We see lower highs in the marketplace. We see lower highs and what? Lower lows. So after taking out this one, the next place it will come for is what? Is the new low it has created that is on that form of liquidity, because that what data that you'll be seeing. They'll be seeing this place now as a point of support. So they'll want to buy here and put their stop loss here, but they will take them out easily. So this market, it never stops. It never stops. It never stops. This is just the shell of the price action we teach. More in depth, like I heard, is in your intermediate course going forward. So I believe you have really learned a lot. If you go back and check these things, you're going to see a great deal of it in effect. So I will be calling it for this particular lesson here. This particular lesson here. So we'll be going down to our next lesson. I think we'll be looking at market cycles. So let's just go to our next lesson. I remain your mentor, and you'll see if you have questions here, you can drop them in the chat channel. You can just drop them there, and I and the rest of your tutors will be available to answer all your questions. And subsequent Zoom sessions will be coming up so that you can ask your questions wherever you are confused, you want us to answer everything, we'll do that for you. So thank you very much, and I look forward to seeing you in the next lesson. Thank you.